Is Japan secretly preparing currency defense operations with U.S. support? Recent speculation in global financial circles suggests that Japan may be preparing to stabilize or support the weakening yen, potentially with cooperation from the United States. While no official confirmation has been issued, analysts note that unusual movements in currency markets and diplomatic channels have fueled new discussion about possible intervention strategies. The Japanese yen has faced prolonged downward pressure due to interest rate differentials, monetary policy divergence, and sluggish domestic growth. The U.S. Federal Reserve has maintained higher rates to combat inflation, while the Bank of Japan has continued its ultra-loose approach, creating a widening gap that has encouraged capital to flow toward dollar-denominated assets. This gap has contributed to a stronger U.S. dollar and a weaker yen. Currency intervention is not new in Japan. Historically, Japanese authorities have stepped in to steady the yen during periods of excessive volatility. The last major confirmed intervention occurred in 2022, when the Ministry of Finance sold dollars and purchased yen to counter rapid depreciation. Analysts note that such measures are typically coordinated with international partners to ensure stability rather than unilateral disruption. Rumors circulating in the financial sector now point to the possibility of coordinated action with the United States. Supporters of this theory argued that Washington has an interest in avoiding an excessively strong dollar, which can harm U.S. exports and complicate global financial balances. Additionally, renewed geopolitical tensions have increased the strategic importance of maintaining stability among major allied economies. Market observers emphasize that intervention can take several forms. The most visible method involves direct buying of yen and selling of foreign reserves, primarily dollars. However, more subtle methods include diplomatic signaling, interest rate guidance, swap lines, and verbal intervention. Verbal intervention occurs when officials publicly express concern about currency movements, which can influence market behavior without actual capital deployment. In recent weeks, Japanese officials have used carefully calibrated statements noting that currency movements are being watched closely. Traders interpret such statements as preliminary steps in the intervention playbook. Meanwhile, analysts detected modest increases in U.S.-Japan financial coordination meetings, further fueling speculation. Critics of the rumor argue that large-scale coordinated intervention remains unlikely given broader macroeconomic priorities. They point out that the Federal Reserve continues to focus on domestic inflation control, and the Bank of Japan is in the middle of a cautious transition period after decades of ultra-low interest rates. They argue that speculative trading may be amplifying assumptions without concrete evidence. The larger question for markets is whether intervention would even be effective in the current environment. Some economists warn that structural trends such as demographic decline, energy import dependence, and productivity challenges may outweigh short-term currency stabilization efforts. Under this view, intervention could slow yen depreciation temporarily but not reverse long-term forces. Supporters of action highlight diplomatic considerations. Japan remains one of the United States' closest strategic allies in the Indo-Pacific region. Strong economic coordination, including currency policy alignment, helps sustain shared initiatives in supply chain resilience, semiconductor production, and defense cooperation. In this sense, currency stability becomes a geopolitical tool rather than merely a financial priority. Meanwhile, ordinary Japanese consumers and businesses are experiencing the effects of a weaker yen in daily life. Imported goods have become more expensive, raising concerns about household purchasing power. Companies that rely on foreign components face higher input costs, while exporters benefit from improved overseas competitiveness. This uneven impact has fueled political debate inside Japan about the long-term sustainability of current monetary policy. Traders in Asian and European markets are closely monitoring central bank statements. Any sign of coordinated intervention could trigger sharp movements across currency pairs, particularly in USD-JPY, EUR-JPY, and AUD-JPY. Financial institutions have begun issuing volatility warnings, suggesting that hedge funds and institutional investors are expanding protective positions in case of sudden yen appreciation. Analysts conclude that, regardless of whether intervention takes place, the renewed discussion highlights Japan's delicate position within the global financial system. The balance between monetary sovereignty, alliance coordination, and domestic economic pressures will determine whether Tokyo and Washington take action or allow markets to continue adjusting naturally. More updates may follow.